Hey, welcome to the New Home Insights podcast by John Burns Real Estate Consulting. I'm Dean Wehrli, your host. Each episode, we're going to bring you some of the best minds in the housing business talking about some fascinating topics or trend or innovation or issue, just like the one you're about to listen to. Enjoy. Hey, welcome to New Home Insights, the podcast by John Burns Real Estate Consulting. I'm your host, Dean Wehrli. Today we have John Burns, founder and CEO of John Burns Real Estate Consulting, and I might say the nation's foremost housing market expert. John, say hi.
I thought that was you, Dean. Hello.
No, that's you. We are going to talk, not surprisingly, about the COVID-19 virus and its impact on first the national economy and then the housing market more specifically. Just up front, I want to say a couple of things. One, we're not trying to be ghoulish. We know the most important cost here is the human cost, but a lot of folks are interested to see what's going to happen to the economy, and we have some insight there, we hope. But two, we also want to establish the date that we're recording because this is such a fast-moving, fluctuating phenomenon. We are speaking right now in the afternoon of March 19th, 2020. All right? So with that, actually, John, let's you and I take a deep breath. And our listeners too. Ready? Okay. Now let's talk about COVID-19. So first, let's just kind of set the stage. We're still in the early stages of this situation. What are the effects so far on the economy?
Well, we've got all our team working out of their house, and I know a lot of other companies are doing the same thing, and just the world is not as productive working out of their house. So productivity is a huge part of the economy. And at a minimum, you have to acknowledge, hey, we've got a huge productivity hit. And then you look at all these other businesses that are going under where they're doing shelter in place in the Bay Area or in Seattle and New York and Washington, D.C. and Houston, which has the $21 oil price as we speak here. Just the confidence hit there is brutal. So this is a very, very rapid and quick smack on the economy. You know, the worst forecast I've seen is Goldman Sachs saying this will be down 5% this quarter, an annual rate of 5%. I can't imagine it not being down more than that. I mean, I think everybody in the world is spending at least 5% less than they used to, or once they stocked up on toilet paper. So, I think this is going to be a really, really tough quarter.
How would that level of a hit compare with the Great Recession?
So all the economists I'm following, the ones I respect and the ones I don't, are all saying it's less than the worst quarter in the Great Recession, which was down 8%. You know, they study GDP closer than I do, but I just can't imagine this is worse than that. It may recover more quickly. I can see that scenario for sure. But, telling everybody to go home for a month we never had something like that in the Great Recession.
Yeah, or 2 or 3 months, right?
Right.
Yeah. So let's start with sort of that consensus view then. What is the consensus view on how this will play out economically?
So there's three views. There's a V-shaped, which is things fall down and come back really quickly. That's basically a quarter of negativity. A U-shaped, which is down 2 to 3 quarters, maybe not as much, and then back. That is definitely the consensus. There is an L-shape that only some of the biggest bears out there are talking about, that this could be a complete reset. And I think it's somewhere between the U and the L, frankly. I think this is there were a lot of problems getting into this with too many sectors of the economy in the world just borrowing too much money, and it's all coming to haunt them.
How long does that last? So let's switch to that then. How do you see this playing out? Expand on that if you can.
I mean, I definitely don't. I don't know, but let me share something that there's a 20-page section in a monthly report we do for our research subscribers called Forecast Risks. And we've been pointing out in there that the stock margin, the borrowing to purchase stocks, is as high as it's been since 1929. So when the stock market corrects, everybody gets a margin call and has to sell more stock. It's a self-fulfilling prophecy. That triggered the Great Depression. And we had the same level. Then we had the same consumer and auto and debt loans. The 58 recession was credit cards. Ours is auto and student loans. Then you got Michael Milken-like activity all over again with the high yield bond market to public companies and private companies. And then you've got, that was the 81 recession, I think it was. And then you've got the tech overvaluations like we did in 2000, all going on at the same time. And then this horrible thing happens, but all those companies that were borrowing money and all those consumers that were borrowing money in all those sectors are now having to deal with the fact that they took on a lot of risk to get ahead, and it's going to be one big massive restructuring.
So some folks aren't going to make it out the other side of the U or the L.
Oh, no way.
Okay.
No, there's a lot of. Well, I wasn't thinking a lot of those tech companies, for example, were going to make it anyway.
Yeah.
A lot of the high yield debt stuff was really a lot of companies betting on them beating their competitors, but their competitors were betting on it too.
Yeah.
There's going to be winners and losers on all this.
So there was always going to be, but maybe this is going to make it play out much, much quicker than it might have.
Right. Okay. Exactly.
Does that mean this? Okay, let's say it's a U or an L. Does that mean? Do you have a sense of how long that U or L continue? How long that part of the economic cycle lasts this time around?
Well, it's very early on here, but it looks like the federal government is following a lot of the same playbook that was followed in the Great Recession to save the economy. So we're going to see a lot of government stimulus here. If it works and if it's effective, that you could see more of a U and things turn around. We also got some news out of France this morning that a malaria drug appears to be effective in treating it. I mean, we got something like that in the next week, and that's already been approved by the FDA. We can have a reset here and get out of this more quickly than otherwise. But to think that there's not going to be devastation that drags on for the next year or two really blows my mind.
Okay.
Are
there going to be some sectors hit worse than others? Like, travel, hospitality, and those folks are going to need bailouts. Anything? Any other sectors, or is it really just sort of those companies who are most vulnerable with over leverage are going to get hit the hardest?
Well, that's it. Now, people aren't talking enough about that. The financial sector is, but it's companies with leverage. And the white paper Kate and Rick from our team did 4 years ago on this now, showed that the biggest borrowing was in healthcare and oil and consumer goods. And actually, the housing industry had not levered up at all because it was still recovering from the last downturn. Now, the healthcare clearly industry is booming right now, at least the medical are, but I bet, dermatologist office and dentist office and all these other places are struggling too. I mean, I know a guy who's been buying dental offices all over the country and probably borrowing money to do so. There's going to be a lot of little companies that people aren't talking about and little industries that are going to struggle.
How about, so for the general economy, for the general state of the nation, do you think these stimulus efforts are going to be a big help? Have we learned our lesson? Will they make a difference?
Well, they made a difference last time. We would have had the Great Depression, not the Great Recession, if they hadn't done that. I'm pretty convinced of that. And I think it's going to help, but I still think a lot of people are going to get hurt. There's also, out of all the bailouts last time, there was also a lot of discussion of moral hazard where, I don't want to get political, and I'm not a policy guy. But if you start to create the expectation that in a downturn you just don't have to pay your mortgage or your rent, that they did that, and then this, the first thing they jump to in the cycle is, well, let's just defer everybody's mortgage payment and rent for a while. Yeah. Eventually, the mortgage lenders and the landlords are going to start incorporating that risk into their analysis and charging more for mortgages and rent. So, all of these policies have a negative side to them too that won't be with us for a very long time.
Yeah, there is kind of a fine balance, right, between trying to save some folks from being homeless or destitute and trying to and making things worse next time around.
Well, I'm already hearing a lot of conversation about that. How do we make sure that we're really helping the people that need it versus those that are just going to take advantage of the situation?
That's so true. I don't know that there's a right answer for that.
Yeah. So So a couple cities, like San Jose, has already announced that they're not going to do evictions during this whole crisis. So there's some people losing their job that are going to be greatly helped by that. There are going to be people who aren't losing their job. They're just going to say, you know what, I don't have to pay my rent this month or the next.
Yeah.
And, that's the kind of garbage I hate to see.
Yeah. Well, maybe that's how you do it, right? Maybe you tie it to job loss or income loss or something like that, or illness, like they used to tie bankruptcies to.
Yeah. Mark Calabria, who's the regulator of Fannie Mae and Freddie Mac, has thought all of this through, and and they put these things in place for if you got your mortgage with Fannie and Freddie, to call the servicer, explain your situation. The servicer has a playbook now that they didn't have last time to work with the person to ideally keep them in the house, which will actually at the end of the day save money for whoever owns that mortgage. I think the Fannie and Freddie are going to look a lot better this time around than they did last time.
Well, that's good. It is interesting with the stimulus, though, how politically everyone becomes a Keynesian when things get really, really bad. Suddenly your former values dissipate.
Yeah, I mean, when you're really talking about people really being out on the street, that's, have somewhat of a heart.
Yeah. So let's switch over to some impacts that are specific to housing and maybe even to builders. So is housing, you kind of touched on it a second ago, but is housing different from other economic sectors? And if so, how's that so?
Well, I think it's I know it is the least over-levered major sector out there. And although interest rates spiked in the last week from 3 to 4.1 today, because there's some disruption in the mortgage market that the Fed's trying to fix. But housing benefits from low mortgage rates. And I draw the parallel. We've been drawing this for a long time that if we were going to have a recession any day, it would likely play out like the 2000-2001 tech recession, where Greenspan dropped rates. He was the Fed chair at the time, and propped up the economy with housing. 10 years after housing had recovered from being crushed in the S&L crisis, it feels very much the same way to me today. Housing not overbuilt, and I think home construction is going to be part of the stimulus package here. And although a lot of industry companies are going to have challenges, they're not going to be the same challenges as 2008 unless the recession is much.
Well, it's almost the reverse of the Great Recession, which was kind of, in a sense, a housing-led recession to some extent, right?
Yeah, this is not housing-led at all, but housing demand comes from people with jobs, right? So housing is going to be impacted by this, and you need to get together and you need to get some construction workers on your site and not told to shelter in place.
Despite that, though, having builder stocks been getting hit pretty hard, every stock is getting hit pretty hard, but builder stocks as well, despite the fact that they maybe are in better shape than other sectors.
Yeah, so the builder stocks were getting hit less hard early in this, and they've been getting hit much harder later. And I saw a sell-side analyst report from somebody I really respect saying they are pricing in impairments and losses into the stock prices already.
Okay.
So,
mortgage rates, you mentioned mortgage rates just a second ago. Do you see, you read that those have spiked lately. They're supposed to come back down with these government efforts fairly quickly. Is that how you read it?
That's the very easy conclusion. I think the conclusion is more complicated than that. So mortgage rates, actually, the spread over treasuries has been pretty tight for a couple of years, to the point where the mortgage companies actually have not been making very much money, just because there's been so much competition in the mortgage business. And they're typically priced over the 10-year, because a pool of mortgages has, somebody paying off their mortgage with a refi 1 year in, somebody holding on for 30 years. It's an average of a 10-year pool of mortgages. So they price over the 10-year treasury. So you're right, when the 10-year treasury goes down, you expect mortgage rates to go down with it. However, in an environment like this, if you're buying a pool of mortgages right now, you're saying, well, wait a minute, I think these people may get some forgiveness and not have to pay their mortgage for a few months. Or we certainly have more risk of price declines than we did 6 months ago. So I'm taking more risk than usual for mortgages, so I need a better return.
Hmm.
And I think that's what's going on.
Because that could be very hugely impactful on housing, right? We've seen housing wax and wane with mortgage rates going up and down. And if folks have baked in this expectation that this recent spike in mortgage rates is very temporary, I could see them sitting on the sidelines here in the near term on that expectation.
Well, I do think the premium over the 10-year is temporary until the economy stabilizes. And if the 10-year is still low at that time, rates will come down. But if what they're also betting is that the 10-year won't come back up.
Yeah.
I mean, my thesis is that if you want to own a home and you can afford the income and you want, just get in,
Yeah.
and you can afford the payment. And then if rates go down again, you can refi. But if rates go up, you missed your opportunity.
True. And heck, they're amazingly low by any remotely long-term sense, right?
Yeah, but because of that, Dean, you and I both know prices have risen a
That's
lot
true.
because rates have been so low, it's allowed prices to go up. So
Yeah. I say that a lot. Effectively, mortgage rates have, right? They've supported housing prices dramatically these last several years.
sure, when rates go down, you can keep somebody's payment the same
Yeah.
and charge them more for the house. And that's what's been going on for the last 30 years for the most part.
So how about the stimulus specific again to housing? Do you think what's happening in the stimulus will help prop up housing as it does the overall economy?
I mean, that's what we're working 24/7 trying to figure out right now. So when our team did some really interesting metrics on Google the last few days, and we got some interesting anecdotes from a lot of our market research. People aren't selling their home, so you're not going to see a sudden supply of homes on the market, but people are just staying put. And these government policies that allow people to stay in their house or hey, we're going to work with you to restructure your loan rather than throw you out, will keep supply low. And then we did confirm that 20% of home buying is investors, and that no matter what category of investors you're talking about, that is falling. And I got to believe home demand is falling too, because some people are very insecure in their job and may lose quite a bit of their savings here too. So net, I think home prices will decline. But if we don't see that huge surge in supply, particularly in distress sales like we did the last cycle, and rates stay low, and we're not overbuilding, we should not see a price correction anything close to the last time if all those things play out.
So a literal shelter in place is actually going to keep supply down and help prop up to some extent the housing market. Is that fair?
I think that is the thesis. In fact, there was some every time is different, but Zillow did some very interesting research looking at 2 prior pandemics. And the early word out of China this time around is the same, is that sales volumes plunged during the pandemics, but prices stayed relatively flat. And that's what I'm hearing in China right now, which is just getting back on its feet. Maybe there's no urgent sellers in China, and they're just going to hold on to prices. So who knows? But there's definitely more risk to the downside. I don't think there's any.
Yeah, I heard you say that earlier, and that was surprising. That it's so common in these kinds of scenarios that prices stay relatively stable.
Well, what happens is if you have a lot of sellers who have to sell, when a bank takes your house from you, they have to sell. When a home builder builds 100 homes and they're sitting empty and he's got to pay back his lender, they have to sell. We don't really have any of that going on right now. We'll have some of it in the new home market, but there's not a lot of speculative inventory out there. And in fact, what is happening right now is the construction is shutting off. Last cycle, the guys kept building in order to be able to pay back their lender and kept putting more vacant homes on the market. Construction is clearly going to slow in the next 12 to 24 months.
How about how this affects different housing markets? Is there going to be a differential impact from this depending on where you are?
Yes, I believe because the markets have played out very differently this time. So some of we have this housing cycle risk index for 50 markets. There's 7 markets, or maybe even 8, that we've characterized as high risk markets now for the last 6 to 9 months. And they've been some of the strongest markets in the country, and that's what's actually made them high risk. Either their pricing has gotten way ahead of themselves or their volume. Denver, Boise, Portland, San Jose, Las Vegas, Nashville, although Nashville could get through this. There's a lot of construction going on in Nashville. Actually, now that I think about it, one thing you and I haven't talked about is multifamily construction. Apartment construction is at a 30-year high right now. So there's going to be a lot of empty apartment buildings that need to lease up. And Nashville would be a prime example of that. I can see some pretty significant rent declines in apartment buildings.
Particularly in those places where they have had a lot of activity lately.
Right. When 300-unit complexes open up empty, what happens?
Yeah. You slash.
Right.
You incentivize at least.
Right. But 2/3 of the country is in pretty good shape. Maybe some of them had an affordability problem, but demand and supply in terms of housing were relatively in balance. So we're at least going into this in far better shape than we were going into the Great Recession.
Yeah, and moral hazard or not, at least we do have maybe some relief, some of those folks that they're not going to be evicted, and you won't. At least if you have sort of a stable rental supply, you should be in fairly decent shape, unless, of course, the recession is much more severe than we hope.
Right. I think this recovery is going to play out very differently for that reason. You also have some big professional Wall Street companies now that are pretty well capitalized who want to buy homes and rent them out. So what I've been asking them is, hey, during the next downturn, when do you start buying? And their answer is as soon as the yield makes sense. So,
yeah.
But that could be a real cushion on home prices. And they'll buy new homes from a home builder too and turn around and rent them out.
Very much so. How about, let's switch a little bit to supply chain. I mean, that's a big concern. A lot of folks have been talking about that really affects the big building product manufacturers and therefore the things that they make for your home. Is that a big concern for you right now?
Well, that's going to be behind very slow construction. It was already a problem. With the tariffs on China, we were struggling in the supply chain. A lot of low-priced products and a lot of particularly steel-related, like hinges and doors or locks, and a lot of appliances were coming out of China. What nobody has been talking about, except Steve Bastin on our building products team, really knows a lot about this, is how many building products come from Italy, particularly countertops and a lot of wonderful tiles that people want. And Italy is in complete lockdown right now, as you know. So there's going to be a supply shortage here for quite some time. So in terms of housing volume, if you will, it's definitely not going to be a U-shaped recovery. We were forecasting modest growth as it was, and it's going to be flatter than that now.
I have heard, though, that some of the Chinese suppliers, anyway, have started to go back to work. Is that true? Do you know?
Everything I've read, I've got a buddy who works for Callaway who's got plants. Everyone says they're all coming back to work and they're ramping up.
Yeah, that's good to know.
Yeah.
This sounds like a good topic for a podcast.
Yes.
Maybe our next one.
On the next podcast.
How about builders? How are builders handling the situation so far? I know UKB Home is no longer having folks in the sales office. Some are doing it with appointment only. Some are much more severe than that. Some are kind of business as usual. How do you think this is going so far, and where do you think it'll be in a week or two?
Yeah, Jody and Devin talked to 89 builders this week, so we're very on top of this. The business as usual is starting to change. Entry-level builders in markets in the Southeast and Southwest are still doing pretty well because they had people interested in buying their homes, and those people are jumping on the low rates. And the number of them, I just heard a story today that was pretty amazing. The builder had locked in rates at 2.875 and then went back to do another lock-in for the next set of buyers, and it was at 4.5.
Oh my gosh.
Yeah, so I hope that's temporary.
Yeah.
But there's some positives coming out of this. And I'll give you another anecdote that was pretty amazing too. Some of the single-family rental guys in the build for rent are seeing apartment tenants leave their apartment and come to their product because I'm less likely to get sick in a detached home than I am in an apartment complex touching the main door with everybody. So I,
Yeah.
I think that's going to be a tailwind for the industry. People are being stuck in their home that they probably didn't like very much in the first place, and now sitting there going, it's probably time for us to get a nicer house. So assuming their economic damage is not too bad, I can see a lot more people moving and moving to new for that reason. And the builders who were using technology to be more efficient have really been forced to ramp up that technology dramatically in the last couple of weeks. And I'm hearing that they've gotten a lot better. And so
Yeah.
I think the operations in the industry is going to be stronger because of what happened too.
And maybe a lot of builders, I won't say any names, can maybe modernize their websites and what they have on their websites. Because let's be honest, a lot of them are 2 or 3 years behind the curve now.
You know,
Just saying.
I've been saying that forever. And then
Yeah.
I went and checked in
Yeah.
Seattle, and I was really impressed that most
Huh.
of the builders, I went to 5 or 6 builder websites. They all had great chat. They all had nice video tours. They had gotten their act together since the last time I looked. So that, fortunately, that is working out well for them. In fact, there was a master plan that had 10 sales this weekend in suburban Seattle
Wow.
on the middle of March.
Yeah, they're going to have to, though, aren't they? I mean, it's going to have to be. So for any of those folks who are business as usual, I mean, stop now because you're going to have to change in a week or two anyway, and it's going to be a lot of what online chats, Zoom meetings, maybe, and virtual tours. Maybe we'll see that virtuality kind of step up, like we've kind of been waiting for a while. I mean, is that kind of the new normal, or is it coming?
Well, I think once when the price comes down on that and the quality gets better, it's going to be the new norm. Well, you've been at our design summit. We've been talking
Yeah.
about that for years. It really hasn't hit its steep part of the adoption curve yet, but this probably accelerates that. I would agree.
Let's talk about one more thing in the housing market specifically, which is are there any parts of the housing sector that might be in better shape than others?
Well, I think single family rental is going to be a big beneficiary. I think who are in apartments who never really thought about renting a home because they would have had to rent from some deadbeat landlord like you or me. Now realize there's some real companies out there that they can rent from. Some of the new build for rent that Christopher Todd and others are doing have some really cool amenities like apartment complexes too. And it's a lower density environment.
Yeah.
One of the things I'm thinking about a lot though, Dean, and I value your opinion on this is far worse in high density urban
Yep.
areas.
Yeah.
I wonder if some people and even some employers are saying, hey, let's go back to the suburbs. That's where everybody wants to be.
I'm not kidding you. I was literally that was going to be my next question. Do you see this working? It's just easier to shelter in place and do things in a suburban environment than an urban environment. In an urban environment, you walk down the street and Sanjay Gupta gets very upset with you. In a suburban environment, you walk your dog and no one's mad at you. It's just, and you're not as likely to be in high density housing, which may be a little more dangerous. I think that's true.
Well, you and I are both suburban
Yeah,
dwellers, so we're
I know.
probably biased. But I think a portion of society is going to say this is better. And I also think the importance that was placed in urban of having stuff to do and go out to bars and restaurants. And
Yeah.
I wonder if that's going to come roaring back or not. People are going to say, you know what, that probably wasn't the best use of my money. In fact, one of the shifts here that I think is going to happen is when we wrote our demographics book 4 years ago, Big Shifts Ahead, we gave each decade, people born in each decade, a nickname. And we nicknamed those born in the 1930s the Savers because they were kids in the Great Depression and they saw what happens when you don't have
Yeah.
savings and bad things happen. And I'm wondering and those people got to an 80% home ownership rate. They never really over levered. It was their kids, the baby boomers, who were over levered. I'm wondering if we flip back to a society that's more afraid
Yeah.
of debt.
Yeah. Or other, I mean, there can even be simple things that might change depending on how long this goes on, like face to face meetings where we get used to having Zoom meetings and no longer need to get on an airplane and go meet someone face to face or handshaking. Have we seen the end of handshaking as a greeting? Let's bow. Let's just smile. I don't know. I mean,
So I'm never going to see you and shake your hand again, Dean.
no, but maybe we do those things a little less. I'm just saying.
Okay.
Just,
Elbow bumps.
we'll say elbow bumps. Yeah. So let's end with just kind of some pros and cons. What do you see as the biggest sort of immediate risk or risks for the near term because of the COVID-19?
Well, I don't understand the health issues. Obviously, that's not my area of expertise. We're tracking the number of cases and the number of deaths in Washington State as the leading indicator, and it's still going up. So that's clearly getting that under control is risk number one. And the sooner we do it, the better for the industry that I know, that you and I know. And there's so much uncertainty around that. And we are not able to lock people down like they can in China too. So I'm concerned that we're not able to lock down like that, but I'm also optimistic that we saw it coming in China and we maybe reacted a little more quickly, or the rest of the country saw it hit in Washington and then reacted more quickly. So although I think Washington's going to get this maybe the worst because they were the first one in the U.S., hopefully the rest of the country responds and gets through it more quickly. Hopefully this medicine that works for malaria and is already FDA approved works.
That really is almost the best thing that can happen is something that gives some certainty that this is going to end. It's whether it's a quicker vaccine than we're hopeful, or whether it's some kind of a drug. I'm sure they're literally testing every drug in their backlog right now for see if it has anything to do with this. That's a big one, I think.
Yeah, no, this guy tested 24 people in 6 days and it made a huge difference. It's already FDA approved. That's what can get things out there quickly.
Yeah. Is that the one that I think Bayer promised to donate a ton of it to hospitals? Is that the same drug I'm thinking of?
I don't know. This was, the doctor was in France. It's a malaria drug. Okay. So I'm sure it's not in high supply, but hopefully they can ramp up the manufacturing quickly.
Are there any things, I guess, besides the malaria drug or something like that make you maybe hopeful?
I mean, I don't want to say no. 2008, 2009 was just miserable and we recovered. And I guess I would say on the hopeful side, I think people are understanding now what's more important, family and health and being together instead of going out every night and borrowing money to have the latest and greatest. So that might be nice.
So what do you see? Let's end with what do you see happening here very near term, whether it's a good thing or a bad thing?
Well, the very near term is I expect more lockdowns and more stress on the economy. And there's a lot of companies out there that are probably failing right now that we haven't heard about. So I think the short-term news economically is going to be devastating, even if they come up with a cure today. So we're advising ourselves and our clients, hey, hunker down. Let's hope for the best, but plan for not seeing each other for a while, and just figure out how to show some austerity and get through it.
Yeah. Well, okay. I guess we'll end there. Thank you, John. Appreciate you coming on.
My pleasure, Dean. I hope I actually do see you in person sometime soon.
You will. We'll be flying again. Everyone out there, thanks for listening. Just so you know, kind of a program note, I guess, we plan on focusing these podcasts on kind of the state of the market and housing, at least for the near term, for a little while, at least. Maybe we'll even have a few more of them. Just trying to keep you as updated and informed as possible and hopefully provide some insights that we are known for about what we might expect to happen next. So with that, John, thank you very much.
Thanks, Dean.
See you next time and be safe.